Let's start today off with a little bit of good news. At least I think it's good news. We've seen a pretty dramatic stock market rally recently, and as a result of this, Canadian household wealth has been hitting new records. And according to Stats Canada, household net worth, that's all the assets that you own, obviously minus what you owe, was up nearly $550 billion, or 3.3% in the first quarter of this year. And that now brings our total household wealth to $16.9 trillion. And that now passes the previous high from early 2022. So a lot of Canadians have been sort of jumping into the stock market. We have bought nearly $24 billion in pooled investment funds, mostly in exchange traded funds in the first quarter of the year as well. Also, even though the housing market has had its struggles recently, the value of residential real estate, that's up by $213 billion, or another 2.6% in the first quarter. That's great news if you're looking at it from the perspective of personal finances. As always is the case, though, wealth distribution is pretty uneven. Stats Canada points out that nearly 90%, in fact, they say over 90% of net worth is held by households that own homes at the end of 2023, and those in the bottom 20% actually had negative net worth. On the debt side, there were some small improvements there. The household debt service ratio, the portion of the after-tax income that's used to pay debts, that was down nearly 15%, 14.91% in the first quarter. That's down from the 14.98% that we saw in the last quarter of 2023. So this means now that the average household spends nearly 15 cents of every after-tax dollar on debt payments. And that obviously has been a long-standing issue for the Canadian economy. Bank of Montreal economist Shelley Koshik, she saw some positive trends in household debt. And she says household debt metrics largely improved in the first quarter as incomes grew faster than borrowing, with the latter weighed on by elevated rates. Now, recently, of course, the Bank of Canada lowered its benchmark interest rate to 4.75 from 5%, and that now marks the first cut in over 4 years. Bank of Canada Governor Tiff Macklem, he did give indications that while more cuts could happen, they are going to be gradual, and he also expects that the growth will gradually pick up. As long as inflation keeps coming down, it's reasonable to expect that further interest rate cuts will happen at some point. This is a bit of news from last week, but because of my schedule, I wasn't able to report it here in last week's reports. But just to catch up, shares of Canadian Western Bank jumped sharply last week after the news broke that National Bank of Canada is buying it in a deal valued at about $5 billion. And the shares of CWB were up about 68%, trading at around $42 a share following the announcement. The deal itself values CWB at $52.24 a share. So it's really nice to see that pop there if you are a Canadian Western Bank shareholder. Of course, this deal, this announcement follows the recent $13.5 billion acquisition of HSBC Canada by RBC. And that has sparked further speculation of consolidation in the Canadian banking industry. So is it part of a broader trend? Well, Nigel D'Souza, he's a senior investment analyst at Veritas Investment Research Corp, and he noted the acquisition of CWB aligns with our expectations for further consolidation within the Canadian banking industry. He also notes that smaller banks often struggle to compete with the larger ones, and this is due to things like economies of scale, the lower funding costs that you would have in a larger bank. So there's a competitive advantage to having the size there. Shilpa Mishra, managing director at BDO's Capital Advisory Services, also noted a trend of mergers and acquisitions in the sector. She says there's an unprecedented level of M&A in the Canadian banking sector. She also pointed to other recent deals, and she talked about National Bank's acquisition of Silicon Valley Bank's $1 billion Canadian loan portfolio, and also BMO's purchase of Bank of the West for $16.3 billion. So this deal now, it's seen as strengthening National Bank's presence across Canada, expanding beyond its strong presence and its Quebec roots. In the announcement, they did say that they will keep the CWB branch locations and Edmonton-based leadership. The acquisition still, of course, needs regulatory approval, and it also needs a green light from 2/3 of CWB shareholders, and a meeting on that is expected in September. The technology space has continued, of course, to deliver strong growth in the first half of 2024, led largely by performance of the biggest names in the sector. Also, of course, artificial intelligence, AI, that's played a big role in powering that growth. Recently, we've seen NVIDIA stock hit a record high again as the demand for their chips put their market cap above the $3 trillion level. And Apple has passed Microsoft as the world's largest publicly traded company after it laid out its generative AI strategy. There is a ton going on in this space. I would like to thank Harvest ETFs for their support in today's video. And I want to make sure that you're aware of one of their funds, the Harvest Tech Achievers Enhanced Income ETF. Ticker is HTAE on the TSX. This ETF is designed to deliver higher income and growth opportunities by applying modest leverage to an investment in the Harvest Tech Achievers Growth and Income ETF, that's HTA, on the TSX. So that means that you get the same portfolio of these large cap tech companies, but you get higher income every month. And if you want to learn more about this opportunity, click the link in the description of this video. Also, probably my last chance here to mention that we're gearing up to hit the road again if you haven't heard. This year we will be in 4 Canadian cities, and for the first time ever, we're going to be making a trip south of the border, and we will be in New York to welcome our new US Blossom subscribers. That is with a stop in New York City on the agenda. Last summer, we met with over 1,000 Blossom members and Investing Academy students across Canada. We look forward to meeting more of you this year. Now, for those of you who couldn't make it out last year, I will encourage you to sign up to one of the events that we're having coming up. We did sell out last summer. So far, it looks like we'll expect this year to be sellouts as well. We will be in Toronto on June the 25th, New York, June the 30th, Montreal on July the 2nd. We're also booked in Calgary for July 15th and then Vancouver on July the 18th. And this year we'll be joined by 15 or maybe even 20 or so different creators that you're probably familiar with. Adrian, better known as Canadian in a T-shirt, will be along with us. Shay, also known as the Humble Trader, will be along with us as well. A lot of you probably watch Daniel Pronk's channel. He will be at some of the events as well. And Instagram and TikTok phenom Joy Yi Yang will be joining us. So if you are a DIY investor, I would highly encourage you to come out and hang out with us. I will put the links for all of these events in the description of this video. Even though the general mood out there seems pretty positive in the stock market, consumer sentiment in the U.S. has hit a 7-month low over ongoing concerns about high inflation and slower growth in household incomes. And consumer sentiment, this is a measure of how optimistic or pessimistic consumers are about the overall economy and their personal financial situations. It is typically assessed through surveys, and the one we're going to look at today is the University of Michigan's Consumer Sentiment Index that gathers data on consumers' perceptions of their current financial situation, their expectations for the future, and for their willingness to make large purchases. And the Consumer Sentiment Index dropped to 65.6 in June. That's down from 69.1 in May. And this is now the 3rd consecutive month of decline. And of note here, this level is now significantly below the pre-pandemic level of 101 back in February of 2020. So this just gives an indication that there is what I would call widespread dissatisfaction amongst Americans regarding their personal economic situations. Also, the measurement of expectations for the next 6 months, that dropped for the 3rd month in a row, now standing at 67.6. Middle and lower income Americans are particularly worried about inflation, it appears, more so than the wealthier households. These groups spend a larger portion of their income on necessities, obviously. Now, Jim Baird, he's the Chief Investment Officer at Plant Moran Financial Advisors, and he says consumers aren't nearly as concerned about the inflation outlook today, but still appear skeptical about how easy it will be for the Fed to engineer an easing of inflation to the pre-pandemic 2% range anytime soon. I've got a good buddy who owns a place down in Florida, and he spends a considerable amount of his year there. He is obviously one of many Canadians who do own homes in Florida, and it looks like they are in for a bit of a financial challenge going forward. Home insurance costs are skyrocketing in the state. Premiums are expected to jump by as high as 40% this year. And then you add this to the higher home prices and a weak Canadian dollar. Florida seems to be quickly becoming definitely a less affordable escape from our Canadian winters. Make no mistakes here, Canadians love buying a property in Florida. We are by far the largest property buyers in the state. We spent US $2.1 billion last year, and that's second only to the Chinese as the biggest international buyers of residential property in the United States. But the Florida insurance market is in trouble when we've seen this high population growth in the riskier coastal areas, which of course is where people want to live, along with rampant fraud and legal battles, which are rising. We're going to talk about that in just a second here. This has pushed over 30 insurers out of the market in recent years. And so those insurers that still are in the market, they've been hiking premiums, they've been tightening eligibility requirements in order to become covered in the first place. A lot of newcomers there. They prefer the coast, like I said, but of course this comes with the higher risk of storms and, in fact, hurricanes. And if we look back just a couple of years to 2022, Hurricane Ian caused over $100 billion in damage to the state. And today, homeowners are often facing extra costs when they insure. Things like wind, flood insurance, and meeting property elevation requirements are also in place. Also, apparently, the insurance market in Florida is plagued by fraud and high litigation costs. I wasn't so sure of that. The state only accounts for around 9% of U.S. home insurance claims, but it makes up 79% of lawsuits, and many of these have been determined to be fraudulent. And this, of course, has resulted in additional significant losses for insurers. Now, if you want to put a cherry on top of all that bad news, of course, mortgage rates have risen over the past few years. 30-year mortgages in the U.S. are around 8% as they sit today. And then you have the weak Canadian dollar, which of course adds another financial burden to many Canadians. So for many, many years, for decades, in fact, for a lot of Canadians, Florida has been the state of choice if they're looking for a home away from home. And we'll have to see whether these challenges will dampen our enthusiasm as a group for Florida real estate. That remains to be seen. Couple of things just to finish off here today. I will put links for our upcoming tour in the description below. I really hope to meet a lot of you there. If you are not subscribed to our Pulse newsletter, I'm going to make that super easy. I will put a link in the description of this video. I'm here Mondays and Wednesdays with this report. As always, thanks for watching. We'll see you in the next video.